The cap rate on this triple net tropical smoothie investment property looks safe at first glance. And honestly, that's exactly why I think investors need to slow down and look deeper. At first glance, this deal checks almost every box passive investors typically like. Long-term lease, recognizable franchise brand, triple net structure, strong growth story, institutional money backing the brand. But here's the real question. Is this cap rate being driven by long-term strength of the investment or simply excitement around the brand? Because there's a big difference between a popular growing brand and a truly low-risk investment property. And that's exactly the type of distinction I focus on when analyzing commercial real estate deals. Welcome back to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker, business broker, and the agent who goes beyond the glossy brochure to show you what you're actually buying. Because when I evaluate deals like this, I'm not just looking at the lease and cap rate, I'm evaluating the business behind the real estate. Now let's dive into it. This is a triple net tropical smoothie cafe located in Jacksonville, Florida, with approximately 15 years remaining on the lease and a cap rate around 5.85%. At first glance, I completely understand the appeal. Florida continues attracting major population growth and 1031 exchange capital. Tropical Smoothie is one of the hottest fast casual brands in the country right now. The building footprint is efficient, the lease structure is passive, and the rent increases provide some inflation protection over time. Structurally, this is exactly the kind of deal many multifamily investors start gravitating towards once they get tired of operational headaches and active management. But this is also where investors sometimes become a little too comfortable with the words triple net, because triple net does not automatically mean low risk. One of the biggest reasons this cap rate is compressed is because institutional money has validated the brand. Blackstone reportedly acquired Tropical Smoothie in a deal valued around $2 billion. And once institutional capital enters a franchise system, investor psychology changes very quickly. Suddenly, people stop viewing this as a smoothie shop and start viewing it as an institutional growth platform. And I understand why. The brand sits directly in the middle of several major consumer trends that are working extremely well right now. Health-conscious eating, convenience, mobile ordering, grab-and-go behavior, and smaller operational footprints. That combination is very attractive to investors. But this is also where I think people start confusing brand momentum with actual credit quality, and those are not the same thing. The deeper question is whether or not this hot brand at this location will also be a durable brand. And this is the part of the deal most investors completely overlook. Blackstone did not buy this specific real estate asset. They bought the franchisor economics. That's a huge distinction, because Tropical Smoothie Cafe is still fundamentally franchise-backed restaurant real estate. This is not an investment-grade corporate guaranteed Starbucks. It's not Chick-fil-A, and there's still operational risk here. And experienced investors understand that long-term lease durability ultimately depends on business durability. Because if unit economics weaken over time, eventually lease strength weakens too. That's why when I work with buyers, we're not just looking at the cap rate. We're evaluating the operator, reviewing the lease structure, estimating rent to sales ratios, thinking about EBITDA pressures, and asking whether the economics remain durable long-term. Now let's talk about the building. One thing I actually like about this deal is the smaller building footprint. Modern restaurant economics are increasingly shifting toward efficiency rather than large dine-in experiences. Consumers want convenience, they want speed, they want mobile ordering and grab-and-go functionality. And concepts designed around those behaviors often operate more efficiently than older restaurant models built around massive dining rooms and heavier labor structures. That's part of why brands like Tropical Smoothie, Kava, Jersey Mike's, Wingstop, and Dutch Brothers have generated so much investor excitement recently. The economics often scale better, and scalability is exactly what institutional investors love. Now let's talk about the risks. One of the most dangerous assumptions in commercial real estate is the idea that triple net automatically means safe passive income, because it doesn't. Triple net simply means the tenant is responsible for taxes, insurance, and maintenance obligation. It does not eliminate business risk, and honestly, I think many newer 1031 exchange buyers underestimate that distinction because the income stream can feel so simple. The checks show up, there's very little management, everything feels passive, and slowly, investors stop asking deeper questions. They stop asking whether the rent remains healthy relative to future sales performance. They stop asking whether EBITDA margins remain durable if labor and food costs rise. They stop asking whether the brand still feels culturally relevant 10 years from now. And that's where investors can get hurt, because eventually every triple net investment still comes back to one thing: can the business support the rent long term? And this is exactly what I help buyers analyze behind the scenes. When I'm representing a client, we're not just guessing. We're reviewing the lease, evaluating the business, analyzing the risk profile, and building a clear framework so you hopefully understand what you're buying. So overall, do I think this is a bad investment? No, I actually think this is a fairly attractive deal for the right investor. If your priority is long-term passive income, minimal management, and exposure to a nationally expanding franchise brand, I completely understand the appeal, especially for a 1031 exchange buyer prioritizing simplicity and stability over aggressive yield. But I would not mentally place this in the same category as an ultra-premium corporate guaranteed asset. And I think investors who aggressively price deals like this simply because the brand feels hot may underestimate the operational risk underneath the surface. To me, this cap rate is really a reflection of investor optimism. The market is betting this brand continues winning long term, and honestly, that may happen. But sophisticated investors understand that optimism itself becomes part of the risk when pricing gets too aggressive. And ultimately, that's really what this comes down to. Not just whether this is a good deal, but whether the risk, the pricing, and the long-term strategy actually align with your investment goals. Because every single triple net investment carries risk. The key is understanding what you're actually buying before you commit significant capital. And if you're actively looking to buy, sell, or complete a 1031 exchange and want help evaluating opportunities like this, you can contact me through the link in the description below. And if you enjoy this type of deeper commercial real estate analysis where we break down what cap rates actually mean and what most investors completely miss, make sure to subscribe, because that's exactly what we do here every week on the Commercial Real Estate Deal Room. I am Mercedes Shaffer. I'll see you in the next deal.